Buddy, Colin Plume, CEO of Noble Gold Investments, Josh Ward, we got Micah. We got an exciting day. And obviously just wanted to say what an amazing Memorial Day weekend. Beautiful weekend. God bless America. It was just, I love, this is one of my favorite weekend holidays. And this, I actually didn't tell you, Michael, we went to a dude ranch over the weekend with the kids and horseback riding, skeet shooting. So my 6-year-olds had never shot. They got their first experience out there shooting.
That's amazing.
Which is just, it was incredible. Their little hands and them getting, the little, the guns are like this big.
Yeah. Oh, that's what a great experience, man.
And then Sharon, my wife, had never shot, which I've been trying to get her out there to shoot. She is literally, we're doing clay shooting. She's a natural.
Good for her.
I think she hit 3 out of, 20 her first time. So, and every time I try to shoot, I get one. I always get one. I think I get lucky, or maybe it implodes on its own. I don't know what happens.
Spontaneously combustion.
Yeah. But and I was researching and just talking about the history of dude ranches and this, Teddy Roosevelt and these, these ranchers, this idea of keeping these alive. And so for anybody that hasn't gone, I highly recommend to go, because it's really a great part of our history in the United States, is these beautiful ranches and horseback riding and getting to see like how people lived. It's just one of the most amazing things you can do as an American. So the one I went to was in Colorado, CU Lazy River Ranch, 8,000 acres. Wow. I mean, just a beautiful place. And the horses, just, you get to ride twice a day. I mean, it was really an extraordinary. You really, living in where we're living now, like to get out and be in nature, it's something everybody needs to do.
Yeah.
I'm so blessed to be in this country, but this kind of attitude that we have, that living and being independent, and and Micah and you guys are gun guys, and you guys can live and survive. And it's becoming more in fashion again, to be able to do these things. Right.
Yeah. Personal resiliency, absolutely, I think is like 100%. Starting to become a little bit more of a household topic. And yeah, you guys know that my daughter rides and I hunt and shoot. So we try to do it a little bit every day, but it sounds like you had a freedom packed weekend, which is the way they should be spent.
Oh, incredible. So it's the two biggest expenses on the ranch. Hay.
Oh yeah.
Can you guess what the second one was?
Probably water.
No.
Bar tab?
No. The bar tab was bacon.
Bacon. Oh, okay.
Bacon.
Yeah.
They go through 40 pounds
a day
every day of bacon.
Wow.
Yeah. They put bacon in even in the dessert, there was bacon. I was like, the amount of meat in my body was just on a whole other level. But anyways, we should probably get to it. So anyways, I highly recommend anyone check out a dude ranch. It's great. It's very American thing to do. But let's talk about what's happening in precious metals. Let's talk about the markets. Let's talk about everything. It's exciting. Micah, why don't you kick it off and get us into it?
Thanks, Colin. Yeah, let's absolutely do it. So as usual, I built us a little bit of a deck to walk through, and we haven't done one of these in a while. So what I'd like to start with is just doing some more topical kind of news related stuff. We know that last week, May 22nd, Congress passed the big, beautiful tax bill, which has some good stuff in there. And then we'll just cover various markets. Just stay on here for a sec though, because it kind of sums up the type of market that we're in. There's so many like discombobulated, kind of like counterintuitive things going on right now. And I kind of just put a little headline here. So, stocks are trading like the trade war is over. We're back into green. We're basically year to date, everything's back in the green from being down by 20%. So it's basically trading like perfection. Meanwhile, bond yields are rising like we've avoided a recession and people are selling bonds like crazy, but oil's selling off like we're going into recession, and the US dollar is dropping like inflation is gone, but also gold is rising like inflation is raging and still here. So there's just like all these kind of mixed signals. So I think it'll be important to talk a little bit about each of these and we can get into it with just a conversation around the big beautiful tax bill. So just throw up
Yeah.
some facts. Oh, go ahead. Yeah,
Yeah.
please.
Yeah. I was just gonna say, and so Trueflation, that website has inflation at, you can pull it up, right at 2.1%. And so, one of the things that I think is I'm concerned about is this, this pissing match between Jerome Powell and President Trump,
Mm.
because at a 2.1 inflation number, you would think that rates would be going down. There's
They'd be cutting.
2.1%.
Yeah.
He'd
Yeah.
be
You'd think
cutting,
they would have
right?
cut. Yeah.
But I think he won't cut just because of this turmoil. There it is, 2.1%. So that's a good sign, right? I mean, that's a good sign that maybe things are getting a little bit better. But unless we lower rates to, fix the real estate market or give us an opportunity, as business owners to borrow at a decent rate, it puts us in a really difficult position. So this is another thing that, like what you're talking about, Mike, is there's all this conflicting information coming out,
Exactly.
and there's no clear path through this year. There's no clear path, and
Right.
and this is the kind of thing that makes business owners really nervous.
Yeah, and to that point, all the trade stuff has been kind of on and off, and even just last week, 50% tariffs on the EU.
Right.
So those were announced, I think it was Wednesday or Thursday of last week, and now they're actually put off until sometime in July. And that's kind of been consistent. He throws on the big tariff and then gives a little bit of breathing room. But these things are causing a lot of uncertainty just for business owners, manufacturing, big business decisions on relocations. And I think that's part of the economic data that's kind of leading to like this more negative kind of consumer sentiment. And the Fed's well aware of all that stuff. So I think that they want to cut. And, again, the inflation rate has been coming down to within their target. But certain sectors, I think it's still kind of creeping back up. So there has been this pissing match, to your point, between Trump and Powell. Powell just kind of keeps saying, hey, we're data reliant. We're going to wait and see. But truth be told, they probably should have cut a little bit at the May meeting. Now I
Sure.
think they're probably likely to when at the next FOMC. But let's talk a little bit about what's been in the news just the last week or so. So just moving to the next slide, we've just got some kind of facts and figures that I've pulled out here about the one big beautiful tax bill and how it's added to public deficits. And we had a recent Moody's downgrade as well. So, Trump campaigned on passing this bill, essentially extending all of the tax cuts from his first term. They were set to expire. Now those are going to continue on in perpetuity, which is great. Some of the other things like eliminating tax on overtime, that's in this bill. Now, there's some kind of commentary on that. Just now that the fine print is out there, it's no taxes on overtime as long as you're making under $100,000 a year, which unfortunately for pretty much any tradesperson, they're all making more than that with all the overtime and the stuff that they're doing. So there are a lot of people who are actually somewhat unhappy with these exemptions or the limits, I guess, to the tax benefit. But what's kind of the bigger picture is that this is very likely going to add a ton of debt to the national debt load, which is already sizable. It's almost 37 trillion right now. The Congressional Budgetary Office estimates that this new bill probably pushes the deficit. So the annual deficit, the overspend that we bring in taxes, probably pushes it to something close to 5 trillion over the next 10 years. Over the next 25 years, this would add an additional 37 trillion to the debt. So it effectively, if that's the kind of course that it's putting us on fiscally, we could see the national debt double in the next 25 years, which is a scary thought. And so,
I would say it's probably going to be faster than that. Because if you look at what happened from 2001, if you looked at our debt, maybe we can pull up our national debt from that. If you look at 2001 to today, I think we were like, I want to guess maybe like 2 trillion in debt.
Yeah.
And 2 to 3 trillion in 2001 to today. So that's over, 24 years. I mean, I think we're moving
huge
in
increase. Yeah, it's
Yeah,
almost like an exponential rate, right? So just doubling in the next 25 years to me almost, even though it's a scary number, it actually seems a little bit on the conservative side.
yeah,
And so, the fiscal problem persists. I mean, we love Trump. He's doing a lot of great stuff, but my own reservation or skepticism around him being able to really do anything
yeah.
to hammer
Time machine.
the deficits and the debt. I think we're seeing it in real time that, we're probably still going to see the debt grow under this administration, despite efforts from Doge to save a little bit of money here and there. Things like this tax bill are just adding to the debt pile. And one of the things that I found was interesting, Colin, is that they actually slipped in the debt ceiling extension into this omnibus bill.
Right.
So they're
I
not
saw
going to
that.
vote on it separately in July.
Right.
Optically, I think that almost it makes sense because they don't want this as like kind of a very contentious and public issue. They slipped the debt ceiling extension through in this bill, so it's actually going to happen all at once. So again, love Trump,
It's a
doing
PR
great
move.
things, but it's just it's the debt's only going in one direction, and that's just
Yeah.
clear, right? And I think that's the bigger concern long term for people's wealth and dollar denominated assets. So
And
uh,
Micah, did Moody's downgrade us before the bill passed or after? I don't know
it
the
was
time.
before, so this was from almost 2 weeks ago, and then the bill just passed, just this last week. So that
Okay.
Moody's downgrade came the week before, and also a bad sign, just for things to come, and it just makes debt more expensive and stuff to service as well. So the credit downgrade's not just, hey, your fiscal house isn't in order, but it's also, it stresses the system, and it stresses all other types of financing and stuff as well. So I just think generally, as much as we think he's taken the country in the right direction, the fiscal trajectory and the whole financial house of the U.S. is still just in pretty poor shape, unfortunately.
Yeah.
Josh, Colin, any comments on that?
Well, it just kind of go. I mean, we've been talking about it all year. It's like spend money to make money. I think that the tariff is costs us short term. The idea is to try to really push people to start manufacturing, buying more here.
Yeah.
I read an article recently. It's actually today even hard to buy all American. It's not that easy to buy as much as people want to. I think it'll change, but we're in a massive transitionary period, just mindset wise, and right now it's affecting a lot of people. And that that inflationary number that I said at 2.1%, part of it is I think that it's just a reduction in spending too. People they're just being more cautious. They're just like, spending is down. So I think that, if you look at that as a whole, this summer, I think the numbers are going to be pretty abysmal in terms of GDP growth.
Yeah.
Consumer sentiment is low, right? Consumer sentiment and CEO sentiment is very low.
Yeah.
So those translate into spending. If people aren't feeling confident, they're not going to spend money.
Exactly.
I mean, what are your thoughts on that, Josh?
Yeah, I mean, I think it's very telling with the Moody's downgrading the U.S. debt, especially in a time where the media and everybody's kind of telling us that things are getting better, right? That inflation's coming down and all these problems are kind of going away. I think it's very telling that we're seeing this, and I think it was long overdue. I remember many years back when the S&P came out for the first time and downgraded the U.S. debt.
Correct.
And then they got-unbelievable backlash from the United States government. And then, other companies have followed suit. And so I think it's very telling. I think we're kind of coming off of this Trump high that everyone has been on since the election, and things are starting to really kind of condense, and we're really starting to see what's going to pan out.
Yeah, and I also think after the first quarter, you talked a lot about this, Micah, about a month or two ago. It's like now people saw their first quarter returns in their stocks. And now I think it's opening people's eyes a little bit. I think a lot of the U.S. people are just like blindly investing in things. But once you get that quarterly report, you go, wait a minute, it's not going as great as I thought it was going. And, I have options. Can I buy gold? What are my options in gold? So I think we're seeing a lot of that where, if we're looking at people that are acquiring from us today, a lot of them were people that inquired from us a year or two ago that just finally got around to it. And that's a big thing that at Noble Gold we really focus on is the education. Sometimes you talk to somebody today and it's not the right time. They need to learn. They need to educate themselves.
Yeah. I actually have a little story just on that, just from this morning, Colin. So I talked to a gentleman last year a couple times, and he understood kind of where things were going. He's actually got a background in finance, and he was really kind of waiting for the price to come down, but he understood the trajectory of the debt, the trajectory of, the economy, and, picture looking bleak and gold being a great hedge. Well, even though the price is up $1,000 from when we first started talking, he's ready to go, right? He's ready to go now because of all this news about the credit downgrade and bond yields rising and the Japanese reverse carry trade unwinding and these types of things. So as someone who's actually a pretty astute kind of finance guy, he's just, maybe I missed the first little bit of it, but there's tons of runway from here on. And yeah, it's a weird market right now. So it's just spooking even some of the smartest people and getting them into gold now. It's great.
Yeah, I think you look at it with like a stock like Nvidia, when it started to climb and climb and climb and climb and climb. Like people, it's a good company. They believe in it. They kept buying it, right? They didn't stop buying it. I think the same thing is in the gold market, because you look at the central banks, like they continue to buy. They're not afraid of the price, and they can buy anything too. So I think, it really is like the price is really a function of what's happened out there and the amount of debt that we've created and turmoil. Yeah. I mean, there's only a few options to go into, right? So it's like, if you want safe, what are you going to invest into today? And then I know we're not going to get into this today, we don't have much time, but I think it's worth mentioning that, the Basel banking laws that, Basel III that they put into place 3 years ago is actually going to come into fruition July 1st. Right. And that means institutional banks are going to gold has become a tier 1 asset for banks. It went from a tier 3, which is a riskier asset, to a tier 1. And actually it says specifically in there that they should buy physical gold, not derivative or paper gold. So not only have the central banks big buyers, now you have institutional banks. You have big banks that are going to buy gold and put it in reserve, and they're going to use it the same way that a central bank. They'll borrow against it. Yeah, it's an asset under management that they can use. And I can tell you that I don't think institutional banks are going to be sellers of gold anytime soon. Yeah. I think they're going to continue to buy gold. So it's like there's only so much gold. The supply goes up by 1% a year. Now you have central bank buyers. Now you have institutional buyers. You have these big groups, these banks buying gold. These banks don't want to get in a position like Silicon Valley Bank and all these other ones that were too heavy into bonds. They want to be diversified. Absolutely. So we have a whole new group of buyers. They're going to come into the gold market and they're going to buy the same bullion that our clients are buying on us, right? Yeah. I mean, the same stuff that we continue to buy.
Exactly. You did a great job on Seth Holhouse, Man in America, talking about that, Colin. Maybe we don't want to get into, but we can, as Basel rules maybe come in. I think that's something for us to cover for our listeners.
We'll get into that more on the next one, but I just wanted to mention that because we're so close.
Absolutely. Yeah, absolutely. It's just around the corner. So let's move on to this next one, just talking about credit worthiness. And this is a very interesting chart. So this shows that the U.S. has the highest public debt expense, basically the interest that we pay for our public debt compared to GDP. It's the highest of any country in the OECD. And by a long shot, we're almost at 5% at 4.6. So this is basically a kind of a factor of we have so much debt, but we also created so much of it at the short end of the curve by issuing like 2 and 5 year bonds back in 2020 when we were printing money like crazy. And so now we're rolling that debt at much higher interest rates as well than back in 2020. So we just have the highest expense of servicing our debt compared to the size of our GDP of any country. And I think that just kind of goes hand in hand with like the larger credit worthiness of the US kind of longer term. And it just, kind of validates the Moody's credit downgrade as well.
And if you look at that chart, you look who's next to us, Greece,
Iceland.
Exactly.
Spain,
Yeah,
Portugal.
Greece
I mean,
had that debt crisis in 2010, if you remember. Like they basically
yeah, I
went
mean,
bank.
all
They
of these
banked.
countries have had problems. High
I know.
unemployment, high debt.
High
These are all
inflation.
high inflation. I mean, the only reason that we're not in a worse position is because we're the world's reserve currency.
Exactly.
That's the only reason. If any of these other countries had that status, they'd be, in a much better position than we are. But we've held on to the world's reserve currency. A lot of people are saying we're not going to have it for long. But, if you looked at this chart, and then if you looked at a chart before the Bretton Woods Exchange in 1944, and Great Britain was at the top, it's the same dynamic, right? That's why things changed. That's why we became the world's reserve currency, because we were, we had low debt at that point. So we're in a precarious situation.
Totally. And so let's actually just kind of look at the next slide here, which shows you what's been going on with bonds. And bond yields have been rising across the board. Every treasury instrument that they have is just up and up and up. This is just from Friday's market.
And that's terrible for real estate too.
It's terrible for anything. Corporate debt that's getting rolled, government debt that's getting rolled, exactly housing's based on the 10-year. We're already seeing, Josh and I did an episode a few weeks ago just covering housing and how we actually have all the telltale signs of a housing correction starting right now, or we're well into it now, like early innings of that. And so this is just bad news. And this basically says a couple things. I mean, either people think that we don't need to own bonds because the stock market is just absolutely gangbusters and it's been a volatile year, but like I mentioned, it's already back to being green on the year. So maybe it's kind of an effect of people saying, well, I don't need bonds. I'm jumping back into the stock market. Everything is fine. But it also could just be a matter of bond investors and bond vigilantes expecting a higher rate because of inflation expectations. Maybe they need a bigger rate to hold the debt for longer. And it could also be because, China and Japan and other countries have been selling treasuries and selling dollars to buy gold. So when they're selling, the price of the bond goes down, but the yield on the price goes up. And so is it any one of those things? Is it all of them? I think
probably all of them.
The answer is all of the above. And what it means is for the everyday consumer is you're getting pinched on any kind of access to debt or access to financing. And it's not good for the economy kind of longer term.
No, and you think about the type of person that would want to hold on to a 30-year treasury note at 5%, right? In this kind of environment, that seems crazy to me. I would be the last person in line to be a part of that.
Agreed.
deal.
Yeah, no, because you just can't. You don't know where inflation is going to go. You don't know where returns are going to go, and so yeah, it makes sense that China is dumping and investors are continuing to dump. They think it's going to continue to get worse. And man, I got interviewed with Pastor Paul just right before this, and we were talking about real estate. The first time home buyer is 38 years old today. 10 years ago, that person was 30 years old. And the median age home buyer is 56 years old. 56 years old, the median age home buyer in this country. I mean, it's unbelievable.
Wow.
Young people are just completely priced out. And then, other people have the golden handcuffs of these low rates, so they're never going to sell. So it's just it's a really awful market.
Exactly. So many different dynamics at play and going kind of counter to each other. So we'll just cover this next slide, which we were in Arizona, the three of us together with Charlie Kirk last week. And I asked Charlie, what are some things that we can do to protect our kind of personal resilience? And what he said was, or you were there, but he said, everyone's got to kind of get a little bit of a handle on AI. And so what I wanted to do just for this slide today as a little bit of an exercise is I literally threw in, create a nice, simple explanation as to why bond yields are rising and make it an illustrative explanation. And boom, 2 seconds, I got this thing, which it summarizes what we just talked about. But these are the reasons why bond yields are rising. And we said, is it one of them? Is it all three? But it's, interest rate policy, interest rates remain really high. Inflation concerns also remain high. Government borrowing is also very high. And, maybe we do have some stronger kind of growth expectations. That one I don't agree with so much, but it's just funny that it can turn this stuff out without any other prompts. And I figured that was kind of a cool thing to do. Yeah. So why don't we call and break here for a quick commercial?
Yeah. let's do it.
Prices keep climbing. Groceries, gas, everything.
I know, even with a new administration, fixing policies, keeping the economy in line will take time.
I'm so glad we signed up for Noble Gold Investments Value Lock program.
We tied our savings to gold. It's an asset that keeps pace with inflation. When prices go up, so does gold.
So when we need our cash, the value's still there.
Secure your savings with Noble Gold's Value Lock. Call 877-646-5347 or visit noblegoldinvestments.com.
I think we need to update that chart because it had prices and then gold was kind of a little bit higher, but actually gold should be like here.
Way higher. I agree.
I think that when we did that about a year ago, we didn't anticipate where the price was going to go at this point. So
I don't think anyone did. Yeah, and we'll talk about gold here and what it's been doing and where I think it's going as well. But if we want to keep rolling, just talk about the stock market. Colin, you made that point. At the end of December, going into January, people's portfolios were basically the highest they've ever been. Right, stock market traded at all-time highs, but by Q1 and at the end of March, like going into pretty much April 1st, and that's when we had Liberation Day on April 2nd, and that bloodbath in the market. Shortly after that, people were down. I mean, we were in official bear market territory. We were down 20% in the NASDAQ. The S&P 500, more than that in the Russell, which is the small caps. So, we went from all-time highs to down 20% or more. And just as of today, like this is what the market's doing. I mean, every single thing is green. Everything is back. We have retraced that entire 20% correction across the indices, and the stock market is trading, like I said, like there's no risk. I think it's I don't want to say it's very odd, but it's just like, we have such volatility and such wild swings in all directions. It's just kind of mind blowing to think that we've been through all that we have just in the first, 2 quarters of this year. Almost, we're not even there yet. But it'll be funny because Q1 or Q4 of 2024 versus Q1 of 2025 versus Q2 of 2025, it'll basically be this massive V. You lost 20%, you gained 20%. And so I don't know what to make up of it other than this just kind of intervention.
I think we're going to see a sell-off in the next 30 days. I don't think there's any way around it. Sell in May and go away. I mean, that's usually how things go. We haven't seen it.
Yep.
So I think it's going to come a little bit later this year, but I can't imagine that people are going to want to ride this through the end of the year because if you're the big money, the hedge funds and all these guys that are buying tremendous amounts of gold, they know what happens in June, July, and August. I mean, it's really, it can be a bloodbath. And so I think the smart money is going to do it. I think we're going to see a pretty massive.
I also think that more skittish investors are going to see it as an opportunity to reduce risk in the stock market as well. And I would probably encourage people to view it as an opportunity to get out. You wrote it 20% down, you wrote it 20%, get out, or at least take some chips off the table. You're right, that seasonality for the stock market, we could see a correction this summer. My take on it, which is just based on listening to a bunch of analysis and the own work that I put into this stuff, is I think we could probably see marginal higher highs. Like we'll see new all-time highs in the stock market at some point, maybe this summer, before like an actual much, much larger correction that'll be tied to the economy slowing down, which will be tied to trade and policies and stuff like that, and consumer sentiment and consumers, reducing spending and all those types of things. So I think it's like, this could almost just be the teaser. We had this very short, very abrupt stock market sell-off and recovery, and it's just kind of setting people up for something much larger in the fall and maybe going into early next year. Just my thoughts.
Yeah, and also you have to think about like consumer sentiment, travel, like what happens over the summer, what kind of layoffs we see, like all of these things can play into it. GDP, like we're going to get a few months of data that could really shift the mindset of investors. I think the only saving grace, in my opinion, is, and this would just a perception thing, but if they drop rates, maybe you see a little
give it a little spurt,
a little sprint. But if they, in my opinion, and I don't think they're going to. If they don't, I don't think we'll see any of that. I don't think we'll see any of that pickup. I think it's going to be a rough rough summer.
I tend to agree with you. And what's interesting, Colin, is if we go to this next slide, it actually shows you that oil's trading like we're in a recession. Again, this is one of these weird things that's like the stock market's doing the opposite of what oil's kind of reflecting in the real economy, which is demand destruction. You only see oil make lower lows like this, and it's respecting that fairly aggressive downward trend line. You only see stuff like this when you have demand destruction, which is a direct result of recessionary kind of spending and kind of economic psychology. People think, okay, well, things are looking sketchy. I'm not spending money on that trip. I'm not booking those flights. I'm not doing that work. I'm not going here or there. And I mean, that's why we just have, again, like so many different pieces of the market are moving in opposite directions. This to me says that we probably have oil going lower through the summer months, and kind of validating your point about those consumer spending decisions that are going to be made. And this is recessionary, but the stock market's just completely disconnected from this, right? And it's doing kind of the opposite. So which one of them is telling the real story here? And I actually think that the leading indicator of a bad oil market is actually more indicative of the global economy as well, not just the U.S.
Right. Yeah, no, I agree with you. And I listen, I look at, everything. I look at all the different investments that I have, and I look at the markets, and I just, I think that there's so much volatility right now there with tariffs on, tariffs off, the trade wars that are happening. I mean, these things are not positive for the equity markets in the short term. There's no positive sign for these things to help the equity markets. And I think confidence is a big part. We know that the stock market is trading in a multiple that doesn't make sense if you look at the actual underlying value. And so much of it is confidence, right? And so if people lose that confidence, you start to see those kind of sell-offs happening. And I also think that, the small little nuggets of things happening, for instance, government travel is going to be considerably down because of the layoffs. That's a big part of airlines and travel in general. I mean, there's all these things that have been cut that affect a lot of the things that are going to happen over the summer. So I do think I'd be nervous to have a lot of your net worth tied into the equity markets. If you're thinking I can ride it out for the next, 3 to 5 years, you're okay. But I think a lot of people, that volatility is tough. And that's why they created a lot of these funds that are out there, right? That are supposed to shift, right? These funds that are supposed to move you in and get you risky and supposed to put you into safe places. They created all these funds because of this. A lot of people can't stomach this volatility, especially as you get closer to retirement. Yeah. I know if I was, a year or 2 or 3 years away from retirement, it would be very difficult for me to watch this with my portfolio.
And actually, you saying that, Colin, just reminds me of something I saw this morning right before we jumped on, which is that positioning in money markets are actually at an all-time high as well. There are a lot of people who are just sitting in money markets right now, not wanting to take the risk of a very volatile stock market, and maybe uncertain about the kind of the direction of the economy or the direction of the equity world in the short term. So they're just holding money markets and cash. But let's look at what the dollar's been doing on this next slide. Like the dollar's been in a steady decline. Here we go. Since the beginning of the year, right? It had a very strong rally after the November election. Actually, that rally started when they started cutting rates back in September, Colin. You'll remember that. Yeah. But since the beginning of the year, the dollar's just been making a series of lower lows. And this kind of trend line that I've drawn that it's been bouncing off lately, it broke down through that. So the dollar's got to recover here above that blue line for it to kind of get back above the 100 level on the Dixie. And I know, Josh, you follow this as an indicator fairly closely. And so with the dollar breaking down, gold only has one way to go. Typically when the dollar breaks down, equities do well also. But if you're holding cash, I mean, you might be getting, 4%, 4.5% on a money market right now. But we've seen the dollar decline in relative strength to other currencies by, 10% just in the last 3 months. So your real returns on holding cash are poor. Like if you're parking your cash to make a decision about where to put it to be safe long-term, I completely appreciate that. But if you're holding on to cash thinking it's actually going to do you any good 6 months to a year or 2 years out, this current trend for the dollar, unless it reverses here hard, you're going to continue to lose 10, 12, 15% of your purchasing power every year, even if you're not losing it in the market, right? Sitting in
Yeah,
cash is a losing proposition.
yeah. I mean, you're typically not going to see bonds at these rates and the dollar be strong at the same time, right?
Well, it's funny because we did talk about this a couple of episodes ago. Normally, when rates rise, the dollar does too, right? Because
Oh, okay.
you get more demand for dollars or to hold
Sure.
U.S. dollars via the Treasury notes, and so normally when rates go up, the dollar goes up, and then rates go down. But we've actually seen this dislocation where rates are going up and the dollar's shooting down, and that's a very abnormal phenomenon that actually kind of spells something a little bit more kind of sinister underneath. Why are they dislocating so hard?
Yeah, maybe rates going up and Moody's cutting our credit. Maybe that combination together is kind of created that disconnect.
Exactly.
And
So
confidence.
then with the dollar, I mean, very, very important market, but let's just get to the thing that everyone wants to hear and just kind of have a look at the gold chart. And so this is really what we've done just in the last not even 6 months. Like this chart starts just slightly before 2025. So we went from 2,500 to 34 and change. Some people were suggesting we probably had a double top there, and a double top means you kind of hit your head on that ceiling twice at that level at around $3,450. I don't think that's the case. I actually think we're going to make a higher high through the summer, depending on the direction that the dollar goes. But all the uncertainty in the world, whether it's the trade war, geopolitical conflicts, these types of escalations, consumer uncertainty, consumer sentiment being poor, this all just puts a floor under the price of gold. And you guys have both heard me on this channel and elsewhere saying, I think the price of gold has to pull back in order to, just let off some steam, right? Any bull market is 2 steps forward, 1 step back, 2 steps forward, 1 step back. And you've got a nice, sustainable kind of grinding higher. But we haven't had that barely at all. I mean, barring the very, very brief sell-off after Liberation Day, which just hit every asset class. It didn't matter what you had, it was getting sold. It's stuck around here, stuck at 33, 34, 32. I think it's going to make a higher high through the summer, meaning the dollar probably rolls over a little bit more as well. And, I know we've got a lot of clients waiting on the sidelines to kind of get that, that right next opportunity, buy it on the next pullback. But I'm telling everybody, you're buying gold as a hedge for the next 2, 3, 4, 5 years minimum. My expectation is that you want to hold it for 2 or more, or this is kind of what I share with clients. So we're looking at probably 4,000 or 5,000 in 2026. Okay. Buying it at 34 or buying it at 32, buying at 30, you might get a 10% drawdown at some point in time, but you're not buying it to trade it. You're buying it to hold it and to protect your wealth for the long term. And Josh, sorry, go ahead, Colin.
Yeah, and I was going to say, you were talking about bond yields, in the 4s, but the dollar losing value, so your purchasing power is dropping. I think long term, when you're looking at the pie, your pie, with this kind of 3,200 range that we're in, gold. I think gold's poised now for 5,000. I don't think there's any. I know it seems a little outlandish to say that these kind of things out loud, but now that we've sort of created this more consistent stair step and you have this consistent buying pool, I mean, the retail market in the US was so late to gold.
Yeah.
Everywhere else was buying. I mean, we were late to it,
right.
Not our clients, but just the bigger market.
Yeah.
So I think that, this $5,000 number is available. That's the number that I'm looking at. I remember, 5, 6 years ago, seeing like 2,800 or 3,000. But now that we've in this world that we're in today, where we have the $37 trillion in debt and we're poised to get to 75 million in 20, 25 years.
Yeah. And that's conservative.
So what is the dollar worth? Like what are things going to cost if we're $70 trillion in debt?
Yeah.
So I think that these are the things that you have to keep in mind, is that the 3,000 or 30, and maybe it seems like a big number, but relative to where we're going and there's no slowing down, it's not a big number. And so banks, and it's the one thing, there's no counterparty risk, right? There's there's a limited supply. There's no counterparty risk. There's no limited supply, and there's no debt when you own it. Like
Right.
how few assets in the world are
Zero.
like that today, and there's not many that
Yeah,
fall
exactly.
into that category.
Yeah, it's really the only one. But you know what's funny, just to throw out some numbers from the low in 2022, which is really when the stock market crashed. And actually that's when we had $1,600 gold. Gold's up over 100% in like
Right.
2 years. So it went from
Right.
1,600 in August, September of 2022 to $3,400, right? More than a
Right.
double.
While silver has basically stayed at the exact same dollar.
Well, you know, it
during
was
that same
17. It's pretty much doubled too. I mean, it was 17 at that time. So gold was 1,600,
22
silver was 17, and now it's 33. So, you know, silver's up almost 100% as well. Meanwhile, the S&P is only up like 66% from the
No,
lows.
and I was thinking just like the past year, right, where we've seen
Yeah, no,
gold
you're
go
right
up
about that.
about $1,000 an ounce, and
silver
has
hasn't
been
moved. Yes.
pretty much about the same. I mean, like I'm talking to a lot of clients where they're thinking gold's up. Okay, well, if you think gold's up, and silver should be dirt cheap, right? Because you can buy silver today at essentially $2,000 gold because it's
Right.
the same price, right? If you didn't buy it a year ago, you could buy it today for about the same price.
Yeah.
Not with gold, but with
Josh,
silver.
and I actually have this last slide. I want you to keep talking about this, but I want to show you this last slide, which actually shows you silver in blue
Yes.
and gold in yellow.
Yes.
And gold's tendency to run first and silver to then lag, but then explode higher. So it performed better in the 70s. It performed better in the 08 to 2011 on a percentage basis. Silver always returns higher, faster returns than gold, but it acts on a crazy lag. So this is, you know, gold peaking in yellow on the very far right with that circle around the top. Silver's going to not only get to that point, but probably shoot past it as it has in every other cycle. So you're right. Buying silver at 34 is like buying gold at 2000.
2000, yeah.
Yeah.
Exactly.
And also, I think, you know, the Fed started buying bonds again. You know, there's some hint of QE happening. Like they haven't talked about it.
Right.
But my theory is that if Powell doesn't, he's going to want to end his reign on a high note, right? And so there's only two things he can do. He can either, you know, aggressively do a QE or lower rates. And I don't know, you know, if he's going to lower rates. I don't know if that's or maybe just behind the scenes, he just starts doing QE again.
Right.
And so that's why I think the $5,000 gold number is a realistic number, because if we see QE happen, like second, you know, third, fourth quarter this year, they just turn and they go, you know what, we got to stimulate, we got to do it. We can't lower rates or whatever we're going to do. And they do QE. I mean, we should, and we'll talk about, next time we should talk about last time they did QE in 2009 and 2011.
Oh, yeah. Yep.
It's gangbusters for gold.
Yep. And 2020. Absolutely. One other thing to add to that, though, is, you know, we talked about bond yields are rising and they're getting a little too high. It's essentially a form of QE. Japan's the only other country that's actually been doing this for the last, you know, 20 years. Is called yield curve control. Mm-hmm. And it's one of the wild cards that's being discussed as to whether or not the US will have to implement yield curve control. And just to explain what that is, we know that when bond prices are high, yields are low. So when people are buying them and there's a lot of demand for bonds, the rate comes down. Well, we're seeing kind of the opposite now. People are selling bonds, right, and the rates are going up. Well, what the government can do is they essentially say, we're not going to allow bonds to go over, or, you know, the yield of a particular bond to go over 2% or 3% or 4%, whatever that is. And they are essentially a buyer, an unlimited buyer of their own bonds in order to raise demand and put a cap. So essentially it's like the only buyer of your debt is yourself.
And that's what they're going to and that's what they're going to have to do.
That is it.
Yeah, I
exactly.
think they're going to, because if the 10-year keeps going up, that means mortgages. I mean, if mortgages get into the 8s and corporate debt gets, you know, corporate debt's going to be even higher, right? Because it trades at a higher.
Yeah.
The whole thing falls apart. So
Absolutely.
I think they're going to have to. I think they're going to have to do that. I think they're going to have to. Maybe they'll cap it at 5, but I don't think they're going. I don't think they can let the 10-year go higher than that.
I agree with you. And, you know, we're 130% of debt to GDP in the US, 130%. Okay. And Ray Dalio has done a lot of research on this, legendary hedge fund billionaire. And he basically says anyone that crosses that 120% of debt to GDP ratio, that's kind of like you've crossed the Rubicon now. There's no coming back from that. And so that's when things really unwind, the fiscal situation worsens. Well, if we end up in a situation where we have to do yield curve control, never mind 75 trillion by 2050, we'll be there within probably 5 or 10 years, not 25. Yeah. Japan, who's been doing yield curve control for probably the last couple of decades, they have 260% of GDP debt to GDP ratio. Wow. So, but they've got one of the weakest currencies. I mean, it is strengthening as of the last few months as this Japan carry trade unwinds and their yields go up. But we do not want to be Japan.
No, we definitely.
But we may not have the choice. So that's where, again, tying a bow on this, the fiscal situation, the big beautiful debt bill or tax bill. You see what I did? The big beautiful.
But that's right. That's you said the right thing.
That's a Freudian slip. But that's where I think things just don't look good. And that's why gold will continue to do its thing. And, people who don't have their position ready yet, they should call us, talk to Josh, talk to me, talk to any of our great team. And essentially, it's not too late. Josh, I know we're early innings as well, right? And what you share with clients.
Absolutely. Yeah. No, and it makes me think of platinum too. I mean, platinum hasn't done a whole lot in the last year or so. And I have a lot of clients that bought platinum and they're asking me what's going to happen? When is it going to take off? And we saw a day last week where platinum was up 5% in one day. It just popped.
Yeah.
And we're starting, platinum's over 1,100 now. And palladium. I mean, I remember when I started here at Noble almost 9 years ago, gold and platinum were 1-to-1. They were the same price. You can get 1 ounce of gold for 1 ounce of platinum. Today, you can get 3 ounces of platinum for every 1 ounce of gold.
Yeah,
which is wild to me.
And platinum
is much rarer than gold.
It is, and at platinum's peak, I think in 2008 or 9, it was worth 2.5 times more than gold.
Yeah,
and prior to that time, it was always the most expensive of the three. So I like platinum too, just as a value play. It's not a monetary metal in the same sense, so maybe it doesn't benefit. But we're in a commodity bull market as well, I think, generally. So I think it'll do well too. That's a great point, Josh.
Well, listen, anybody that's looking to talk to some really smart people, call Micah, call Josh. You can call and ask for them. These are our senior guys over at Noble Gold. You're just going to have a friendly conversation, give you a lot of information. You can get my book. You can, just learn as much as you can, and we're here to help. So hopefully today was interesting, exciting for people. And listen, these guys really know what they're talking about in the precious metals market. So give them a call. Thank you, everyone. Thank you, Micah. Thank you, Josh. We appreciate it. And looking forward to seeing